morning traders, this is your Forex market commentary brought to you by Real ECN. Today's commentary, we will explore the pound dollar market. An upbeat in the UK jobless claim print has given the cable a brief boost to its bullish buyers. Technical indicators are showing signs that the pound dollar pair may be trapped in a congestive trade due to the lack of risk event that can have a profound effect on the Bank of England's interest rate policy. I hope that this commentary will prove to be insightful for our traders in formulating a successful trading strategy. So first in line with this discussion, we are going to explore the pound dollar market on the technical front. Here we have a chart of the pound dollar on a 1 hour time interval, and through this commentary we will break down the technical aspect on the 1 hour chart. The narrative for the pound dollar pair so far this week has been tainted with moderate volatility. Over Tuesday trading session, the UK industrial production, despite beating previous reading, it failed to exhaust the correction to the downside in the pound dollar market. In addition to that, the UK manufacturing production month on month also coming in line with expectation, but did very little to boost a rally in the cable. However, it was yesterday UK Cayman count change which showed that the UK economy loses less jobs than previously expected. This has allowed the market to price in the expectation that the UK's recovery will continue to remain robust and bid for interest rate hike by the BOE will strengthen. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, net retail traders' short interest on the cable has fallen to record lows. Currently, there are 2 net short pound dollar interest for every 1 long position taken up by retail traders. The contrarian standpoint to this crowd sentiment allowed analysts to suggest potential headwind weakness in the cable due to the conversion between net long and short interest position in the pound dollar pair. The level of net long interest at present is equivalent to that when the pair bottomed out at the 1.5300. As long as the cable can sustain trading momentum above the 1.5900, bullish buyers will continue to hold true for the pair. On the intra-month time scale, the price action on the pound dollar pair in recent trading weeks has broken below the solid support floor that began back in October of 2013. Now this former support has turned resistance. Currently, the pair is trading within the boundaries of the descending medium-term channel, where the support of this descending channel is set at 1.6688 level. Since the pair is trading relatively close to its support floor of the descending channel, analysts are suggesting that the risk and reward profile of this trade does not justify a point of entry at this moment. Analysis of a collection of technical indicators on the hourly time interval on the pound dollar cross is suggestive of a temporary neutral market sentiment and recommend hold positions on the pound. The pound dollar pair opened today's Sydney trading session midway between the established Fibonacci support at 1.6783 while the Fibonacci resistance is set at 1.6793. The pair opened today's Sydney trading session above the 200-day simple moving average, which allowed the market to continue to upgrade their long-term outlook on the cross to bullish if it continued to hold above the 200 days. The significance of 200-day simple moving average can not be understated, as 200-day simple moving average contain more or less 1 year's worth of trading data. This bearish viewpoint is not validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5 and 10 but above the 20 and 30-day simple moving average, which is indicative of a neutral recommendation on the technical front on the short-term moving average. Now moving along to the fundamental aspect of the pound dollar market. Over in the UK, yesterday trading session, Cayman count claim was the most highly anticipated risk event this week on the calendar for the cable. The UK economy showed an improvement in the labour market and a fall in nationwide unemployment rate. UK jobless claim after revision fell by as much as 227,000 claims in the month of May. However, the wild card is the real wage growth, which continue to remain stagnated. This plays an important role in hindering the BOE willingness to hike rates sooner than later, as wage growth is often associated to consumer spending. In fact, the UK average wage growth contracted to 0.7% from 1.9% on a weekly basis. Stagnated wage growth can become a real concern, especially if it can hinder the prospect of inflation growth. Most likely the cable would be trapped in a congested trading range against the greenback. Over in the United States, in accordance to the VIX index, which has fallen to a 7-year low, indicate that risk aversion has remained subdued. The dollar holding the safe haven torch in the FX market tend to benefit greatly during a time when risk aversion becomes the prevailing theme, coupled with the contraction in global liquidity. Ever since the ECB implemented negative deposit rate last week and the Feds continue to hold strong onto its near-zero interest rate policy, liquidity will not likely become a problem in the immediate future. Monitoring the yield curve on US Treasury, the 2-year can help investors engaging the market expectation on the time frame of interest rate hike by the Federal Reserve. Based on the recent Fed's rhetorical, the market doesn't expect the Fed to hike its benchmark rate until mid-2015. I want to thank all our listeners for spending their time with us, and have a good trading session, everybody. Good luck.